Today I'm here to talk to you about emerging markets. I think I would like to, first of all, thank the organizers for having the conference here, because when I pulled up today, while it was raining, I could look across the street and see the Colombian flag flying. So it makes me feel like I'm in emerging markets. Looking at that flag, I was in Colombia not too long ago, and Colombia is really indicative of where we see the asset class today. It's an investment-grade country, and you're seeing very strong growth in Colombia, very low debt levels, and it really reflects what we see in the asset class today. Before going to the presentation, I just want to tell you one very quick thing. I was when I flew to Italy on Sunday, I was at the airport and I looked up and I see this map of the world, and every country, it either said either customers or opportunities. So North America said customers, Europe said customers, Australia said customers, UK customers. I mean, there were a few other countries that said customers. But then you looked in places like Latin America, Africa, Southeast Asia, it said opportunities. And then when I looked on the further on the wall, it was an advertisement for Heathrow, for the airport. But I thought, wait, this is a great advertisement for what we do. We see the opportunities today to invest in these emerging countries. And clearly, this is an area where we believe investors should be allocating more of their portfolio to. In fact, there's been a few recent studies done, one particular by the IMF that was done last year, which did a survey of global pension funds, and they found on average global pension funds had less than 1% of their portfolio allocated to emerging market debt. Now, by any measurement, that's a significant underweight to emerging market debt. When you break it down by region, which they didn't do, but I know this from what we see at Aberdeen, U.S. pension funds are significantly, have much less than 1% of their assets in emerging market debt, whereas European pension funds, especially in Northern Europe, have much more than 1% allocated to emerging market debt. So, clearly what we've seen is pension funds in certain parts of Europe are ahead of the curve, whereas some of the biggest pension funds, especially in the U.S., are well behind the curve. But I think there is a story there which suggests that these pension funds will be allocating more of their exposure to emerging market debt in the future. So briefly, just in terms of the risk return on emerging market debt, this is shows you what has happened over the last 5 years. Now, if I go back 10 years, the numbers will be very similar as well. But effectively shows you here that the risk return for emerging market debt has been the most attractive asset class in amongst other global assets over the past 5 years. Volatility is coming down. In fact, when you see the volatility here on the chart, you'll see that volatility is actually much lower compared to equity markets, and I think this speaks to what we see in terms of the not just the attractive yields, but the reduced volatility in emerging market debt. There's a lot of perceptions still today, that emerging markets are very, very risky, and I think what I'd like to do is just highlight a few things here in this slide which suggest otherwise. Now, when you look at comparison of two countries here, it's pretty obvious to see which country is a developed market country and which one's an emerging market country. So actually, what I would like to highlight here as an investor, where we see the opportunities is clearly in countries like Mexico, which are again investment grade country. Today you see still attractive yields in Mexico, better growth outlook. Generally speaking, you have a very moderate and in some cases stabilizing debt to GDP ratios in most countries, especially like Mexico. Whereas the outlook for the U.S., as we know, in the coming years, you're probably going to see still rising debt levels, and depending on the outcome of the upcoming discussions with Congress and the Senate on the fiscal cliff, we could see still a continued increase in debt levels in the U.S. in the coming years. But the bottom line here is Mexico is a country which we believe is really one of the great stories in our asset class. Again, another comparison between emerging markets and developed markets is the overall debt to GDP levels and the fiscal deficit. So you see here the countries in the blue circle are generally developed market countries, whereas the countries in the red are the emerging countries. Now, if I looked at this chart 10 years ago, it would have been upside down. So you would have had the emerging countries where very heavily indebted, had many cases unsustainable fiscal deficits, whereas developed countries were generally in a pretty good position. Whereas today, we know it's the exact opposite. And I think what investors have to realize is that the opportunities are still there in these emerging countries where we believe there's some attractive return opportunities. Yeah, again, when you look at sort of, if you want to go out, 30, 40 years and look at the trends, which a number of economists have pointed out, is the fact that emerging markets will continue to grow in terms of their importance of global GDP. So if you look at today, roughly emerging represents around 40% of global GDP, whereas the year 2050 will represent around 70%. Now, one quite interesting thing I heard in a recent research trip to Africa was speaking with the U.S. Political analyst about Nigeria, about the importance of a country like Nigeria. What he pointed out to me was by the year 2050, Nigeria will be the fourth largest country in the world. That never dawned on me, even though I look at Africa quite closely. And when I realized afterwards, I realized that just highlights the opportunities in a country like that. And as an investor, when you go there, you recognize that it is still a fairly dangerous place to walk around on the streets by yourself. But at the same time, it is an opportunity we see as an investor, because one of the things that we do at Aberdeen, we spend a lot of time researching some of these new frontier markets. And for the most part, they're not widely followed by the banking community. So we see that as an opportunity, really exploring, getting down the ground and visiting a number of these different countries. Again, another important thing to highlight is the consumption story in these emerging economies. One of the countries I went to on that recent trip to Africa was Ghana. We drove up the Cape Coast in Ghana, and it was just remarkable to see the different little villages, the economic activity going on in this country, the consumption story, and it's not just, again, in these small frontier markets. It's countries, big emerging countries like Brazil and Indonesia, where you're seeing a growing middle class in these countries, which are obviously going to be an important driver for growth going forward. China, another one to highlight. We know Chinese officials are trying to rebalance the economy. It will take time. It's still an investment-led economy, but you are going to see consumption start to play a bigger role in growth in the coming years in China. In fact, this explains why you have seen in recent years double-digit wage inflation in China in order to boost consumption. And pretty soon you will see China exporting inflation to the rest of the world. So this is a changing dynamic that we see in our asset classes. This consumption story. Just briefly, when you compare yields today in emerging markets to developed markets, we still see an attractive differential there. So these three different asset classes, hard currency debt, local currency debt, and corporate bonds, still offer yields anywhere between 5 to 6% versus sub 2% in the U.S. and in Germany. Now, of course, BTBs are yielding 10-year BTBs around 4.6, 4.7. So we still believe emerging markets are still an attractive area, compared to, say, BTBs. But more importantly is the reduced volatility, the reduced risk that one will be getting by diversifying these emerging markets. Just briefly, the credit quality, something which I've spent a lot of my career focusing on. Prior to joining Aberdeen, I spent over 10 years at S&P. So I always tell people, don't hold that against me. But it is something which I look at quite closely, is these trends in terms of the credit quality. Today, the asset class on the left-hand side, which is the hard currency index, is now investment grade. It has been for the past 3 years. Over 60% of the issues in that index are now investment grade. Whereas on the right-hand side, you're looking at over 80% of the index. The local currency index is investment grade. The average rating is BBB+. This differential between developed market ratings and emerging ratings will continue to narrow, I believe, in the next 10 years. And this rather colorful chart just kind of highlights the progression of the credit quality in emerging markets. You can see, if you go back to the early 1990s, and those of you who remember emerging back in those days recall it to be a pretty volatile, risky asset class, and clearly there was only a handful of countries which were investment grade, whereas today you can see, as I said, over 60% of, and these are foreign currency ratings too. I wanted to highlight that, but again, you can see the steady progression of investment grade countries. Our universe as well is really starting to has been developing as well, which provides more and more liquidity for investors in this asset class. For example, you can see the bulk of the issuance is in local currency markets. And why is that significant? The reason for this is because most of these countries today can finance themselves locally, and that's very important because 10 years ago, 15 years ago, a lot of emerging countries raised financing in the U.S. dollar bond market. Whenever there was a crisis in one part of the world, you had contagion impacting a range of different countries. Whereas today, the big countries that we invest in, the Brazils, the Mexicos, Russias, Turkeys, South Africa, etc., they finance themselves locally. And I think this is a key, one of the key factors which is underpinning the credit quality in our asset class. Now, probably the one area to point out which is really developing in terms of its size is the corporate bond market, which Aberdeen is well placed, we believe, as a company to assess, given that we've been investing in emerging market countries for the better part of 20 years now. Briefly, just shows you the debt issuance in emerging local markets. The debt issuance is, said the bulk of it, close to 90% of the financing today is raised in the local markets. And the low level of issuance in external markets now is opening the door for emerging market corporates to come to the market. This is, again, another important feature for these companies to be able to tap into financing and to develop. And this is obviously positive for growth too. When we look at the corporate market, as I said, Aberdeen collectively between our fixed income and equity teams have research on over 1,000 companies. I think it's again something which we will continue to add resources in going forward is our corporate analysis. The growth of the asset class, again, when you compare here just the size of different asset classes, the U.S. investment grade market is clearly still viewed to be the most liquid bond market out there. But when you look at the overall AUM of emerging local currency sovereign bonds, it now exceeds the size of the U.S. corporate bond market. But on the right-hand side, just to point out, you see the size of the recent issuance and the increased liquidity that one can get in the emerging market corporate bond market is another development. It's another structural story. And also another key structural story for us is the investor base. And I think this is something which is a very important thing to highlight. We have seen in recent years inflows not just from starting to pick up with the pension funds, as I highlighted at the outset, but we're also seeing as investors, at Aberdeen, we manage money for sovereign wealth funds, for central banks, for insurance companies, for big institutional investors, and I think this is the asset class. This is the investor base, which is now coming into emerging market debt. So, clearly, this is a structural story which we believe will continue to play out because, as I said earlier, most global pension fund investors are underweight emerging markets. Now, another feature of our asset class is the development of the local investor. Whenever we look at local markets or talk to local dealers, we always ask, what are the locals doing? You can see here on the left-hand side the growing importance of the local pension funds. You even have local pension funds in a place like Nigeria, which is hard to believe, but and they are major investors in the long-dated government bond market as well. But it's just, again, on the right-hand side, you can see also the growth of the insurance companies in emerging markets too. So this is a very important feature. It's not just the growth of the interest from foreign investors, but the growth of the local investor base. And again, just to reinforce what we believe is a structural story is the very strong inflows into the asset class in recent years. This year, for example, expected to be a record year of inflows of around 85 billion into emerging market debt. And I think we will continue to see inflows, certainly in a lower for longer world that we're going to be in for the next few years at least. You'll continue to see investors allocating, we believe, more to emerging markets, given both the fundamental story and the still attractive return story. Just another comparison here between an emerging market bank and JP Morgan, which everybody in this room has heard of. But I think what this just sums up is the fact that not only does Bank Homer, which is one of the largest banks in Mexico, have a higher net interest margins, slightly better capital adequacy ratio, a higher return on equity, but more importantly has a higher yield, a higher spread. And this just again sums up the fact that added premium you can get by investing in emerging markets is still there. Yes, yields have come down, spreads have narrowed. Some of that is liquidity driven, but I think most of it actually is due to the fact that we are now viewed as an improving credit class, credit quality, and also, generally speaking, investment grade quality. And this is another feature which attracts big investors into emerging markets. Lower default rates. Again, when you think about emerging markets, there's probably still this myth that I'm taking on higher default risk by investing in emerging markets. The answer is no. We believe, certainly over the last 5 years, the evidence backs it up that we have had lower default rates in similar rated emerging market companies compared to their global peers. And this is, again, reinforces this improving credit story that we firmly believe in. I know we've had a few comments earlier today about the external positions in global economies. When you look at the external position in emerging markets, again, this kind of reinforces the view that sovereign balance sheets are generally in a very good position. So we've been running collectively as emerging countries have been running current account surpluses over the past 15 years. Inflation, yes, at times inflation is a risk for emerging markets. If you go back to beginning of last year, you couldn't have a conversation about emerging markets unless someone talked about the risk of inflation. However, that was a period where you did see inflation start to weaken in the second half of this year. My expectation is that inflation probably starts to pick up again in the second half of next year. And, for the most part, we believe that central banks will tighten monetary policy in order to address inflation expectations because, most central banks in emerging markets today are inflation targeters. So we believe that this will hopefully be the appropriate response. And then just in summary, as I said to you, I've tried to explain in my presentation, we believe the fundamental story in emerging markets is a strong one. And that you have certainly in recent years much lower default rates. Perceptions. I think there's still this perception in some places, especially when you meet with investors who are not knowledgeable about the asset class, that it is a riskier asset class. I think those perceptions are slowly eroding, and we believe that. When you really dig deep into the balance sheet story of countries and companies, you'll understand that these perceptions are just that. They're just perceptions. It is a rapidly growing asset class in terms of the investor base and also the opportunities. That's another important thing to highlight is the increased liquidity that investors can get. And we at Aberdeen place a lot of emphasis on liquidity. So we tend not to invest in smaller, more exotic markets where liquidity is a risk. So that's, again, something just to point out to you. The inflows are structural. We believe they'll continue to be attracted by the story in emerging markets and the search for yield. And then the bottom line here to highlight, why am I here today to talk to you? We believe that emerging market debt offers some very attractive return opportunities, and that's something that we think pension funds should continue to think about in terms of future asset allocation, and that emerging markets does deserve a place in your portfolio. Thank you for that, and I'll hand it back to the moderator.